Okay, good morning and happy Friday, everyone. Welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Let's go ahead and get started because there's a lot to share with you. There's been quite a bit of volatility here in the markets, but not a whole lot of movement. So we want to talk a little bit about the individual sectors and what we're currently seeing. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off as we normally do with the market update. We'll take a look at quite a few markets here this morning to take a look at where we currently stand. We'll look at some of the movements we've currently seen from commodities and the fixed income markets that can provide us with a little bit of glimpse into what is likely going to happen in the equity markets. I have quite a few of the consumer and housing trend data to share with you to drive some of the thoughts that we have around consumer spending and where there are some strength and weaknesses in the economy. I want to do a full sector review here today, so we'll look at all 11 sectors, which ones are strengthening, which ones are weakening, which ones are near support, which ones have a little bit more downside, and then share with you a few ideas here at the end. And if we have a few minutes at the end, we'll open this up for Q&A. So let's go ahead and get started. But the primary question that I want to help answer is really just how much further downside is there for equity markets? And before I get started, over the past few weeks, we've been doing this poll. Over the next month, how many of you feel that markets are going to be higher? Please type H. How many of you feel that markets are going to be lower? Please type L into the chat window. Okay, so wow. I do think that we've had a bit of a shift here in sentiment. I seem to see a lot more L's than H's here versus last week was a lot more mixed, I would say. So seems like investor sentiment shifting a little bit here to the downside as equity markets fail to rally off of any support levels. So what I'm going to do today is share with you my charts where I'm currently viewing the major markets, indices, and indicators that gauge my directional view here in the market. So let's first start off with the S&P 500. The S&P 500 has managed to make its way back to the June 8th highs. And we're just sitting around that level, just shy of that level right now at the open. Now, a break below this level really puts us back into the 310 level. So if we look at the S&P 500, which has been weaker than the NASDAQ 100 index, what we have had is lower lows confirmed by the momentum indicators. Money flow remains fairly weak on the daily chart. On the weekly chart, this is a little different. We've managed to get back to the 20-week moving average, which historically has provided a fair amount of support. So on the weekly chart, we're coming up against support levels. On the daily chart, we do have a little bit more downside to about that 310 level if the S&P 500 cannot hold this 323 level, which today it's just opening up right around that 323 level. So important level to pay attention to here on the S&P 500, which again is significantly weaker than the NASDAQ 100 index. If you look at the NASDAQ 100 index, besides the initial plunge, which got us down to about that 270 level, the markets are just about 2% lower from that. Since then, we've had a lot of volatility, meaning we've had a lot of choppy trading in between, but we're still roughly, within 2% of that initial plunge. The line in the sand that we have here is the fact that the NASDAQ 100 is below that 270 level. So far over the past couple of trading sessions, market price action has been wishy-washy. Monday and Tuesday, price action was fairly strong. Wednesday and Thursday, much weaker price action. We'll see how we end up the week. But so far, the 260 level, which is where predominantly most of the volume was traded in between here, has held that level. A break below 260 would put us back down into the 250 level. From my perspective, that is the limit of the downside that I see here for equity markets. It's 310 on the S&P, 250 on the QQQ at the current moment. If we break below those levels, then we put ourselves into a real bear market here, back into the low 230s, 225s here on the Qs, and potentially even lower on the S&P 500. So major markets so far still holding some support levels, but hanging in there by thread. hasn't seen that acceleration to the downside, but if we look at other markets, this is where we start to see some concerns. If we look at small caps, IWM recently broke below 148. Yesterday, it broke below the 200-day moving average in addition to that. So we've had two breaks of some support levels here, the 148, the 200-day moving average. This could put the IWM back into this 136 area. So small caps looking weaker here, not particularly a great sign for a continuation higher here for equity markets. I do think that we still see a little bit more downside here. The equal weight indices so far still providing quite a bit of defense here. The equal weight holding that 200-day moving average despite breaking below that support level. If we see a break below that support 200-day support level here today, I think we're going to head down into the high 90s to the downside here for RSP, which again, if you add all these things up, certainly means that we have a little bit more risk skewed to the downside here if we look at the broader markets. Emerging markets also breaking to the downside. Emerging markets holding in fairly well here over the past few weeks. We talked about the support level, I believe it was on Tuesday or last Friday, but we started to break below these levels. So emerging markets, from my perspective, I think that we're headed down to this $41 level here to the downside. You have this major, I would say, support or resistance level around 41, which corresponds also to the 200-day moving average. So on the daily chart, I think there's a little bit more downside here for EEM, especially when we're starting to see emerging market bond defaults start to rise. I think this is some of the concerns that the equity markets are starting to price in from the fixed income markets. When we look at the VIX still remains fairly elevated, and recently it has been making higher highs going into the election as we approach the election, and there's a lot of angst from investors for the election. This is where I do think that we could see one more spike here to the upside here for VIX as it kind of trades above that 200-day moving average, and it's just below that 30% level here. I think we're going to open up potentially a little bit higher and could see a spike higher here on VIX. When we look at the put-call ratio, the put-call ratio continues to climb. This is the 20-day ratio is now back above 0.6, which historically is still a pretty extreme level. But as you can see, we've seen multiple readings here in the 0.8 over the past few weeks, which has driven the 20-day put-call ratio higher. The 20-week put-call ratio still slowly turning around here, certainly has bottomed and is starting to turn around here. So complacency is no longer there. We're starting to see more and more investors buying puts here in this particular market environment. Keep in mind that this type of indicator is a contrarian indicator. The more put buying there is, the more the markets are kind of near a bottom. Now, we're nowhere near extreme levels like we saw back here in the March lows. Those are what I would consider extreme put buying, and that would be a contrarian indicator. So for right now, I think we're just back to more normal levels, if you will. But if we start to see put buying approach that 1.1 level, that's when we would consider that as a market bottom here. When we look at the VIX to VIX 3M ratio, this has continued to decline here this week, meaning markets are becoming a little bit more fearful, especially as we approach the election. This is something that we expect to see, but it's still in fairly normal territory. It is not below 1. Only below 1 do we consider markets in a risk-off environment. We're not quite there yet, which is why for now, our expectation as far as any more downside is really more of a slower grind than a fast acceleration to the downside. Once we see some kind of movement here below 1, that's when we would expect to see a much faster acceleration to the downside, where it would warrant potentially buying puts on your portfolio. The dollar index, we talked about this on Tuesday, dollar index forming this head and shoulders formation, finally breaking back above that $94 level. Next level of resistance here is around the $96 level. We've really seen some movements from fixed income markets this week, and this has had a ramification on currencies. For those of you that trade currencies, pretty much across the board, we've seen the dollar strengthen. We've seen euro take a hit. We've seen most of the developed country currencies take a hit. The only one that hasn't taken such a big move here is dollar yen. But this certainly has ramifications on gold. We've talked about this triangle here on gold for quite a few weeks now. And we finally got the breakdown to the downside here. There is some support back here around the 170 level, so I do think that you could see a little bit more downside here in gold. If we break below 170, that's when we can get down to the 164 level here. But for now, I'm not sure that we're going to get all the way down to that 164 level, but I certainly think 170 is likely here on gold. A little bit more downside here for gold. Crude continues to, despite the recent rally, start to fade a little bit. If you look at the long-term chart, it is well below that's $42 support or resistance level. It got rejected there at that level here a few weeks ago, and it is now starting to trend lower. I think the news this week of California wanting to move all of the cars to removing all gas powered cars in 2035, I believe it was, certainly has put a dent in oil prices, and certainly put a dent in some of the energy stocks this week. So energy continues to underperform. Money flow remains fairly weak here on the daily chart here for oil. I don't anticipate seeing a big pick up here in oil. If anything, I think you're going to see more of a slow grind lower here for oil, especially as that 200-day moving average continues to slope down. Another thing that we've brought up here over the past few weeks is HYG. HYG, we talked about this breakdown here on Tuesday. After the breakdown, it came back to retest that $84 as resistance and was rejected here yesterday. It was rejected here on Wednesday. And yesterday we closed below the 200-day moving average. So high yield starting to see some significant outflows here. I think on the downside, we would expect a revisit up to this 80, 81 level to the downside. This is, from my perspective, a bigger warning sign than some of the other things that we're looking at. When we see high yield investors pull out of these types of funds, especially with considering the fact that these are funds that the Fed is actually buying. The Fed is directly buying HYG ETFs. This has never happened historically. And when we have a confluence of that and selling in these particular names, this for me is actually a bigger warning sign for the markets. Especially if we look at 10-year yields, 10-year yields remaining fairly actually declining this week, meaning there's more demand here for risk-free assets with treasuries, and you put that in context of HYG seeing some outflows. This is telling me that the fixed income markets are sending some signs as far as what their expectation for, maybe Q4 and next year is going to look like. So HYG, one to pay attention to. Some of the economic numbers really, from a housing perspective, housing still remains extremely strong. This is one of the few sectors that we remain fairly bullish on here, whether it's a home builder stocks or the housing stocks. These are all the stocks that have continued to see significant improvements in terms of number of houses sold, and you put that into context of the number of inventory that's available at all-time lows while home sales are at all-time highs. This is really why you have this continued support, in my opinion, for some of the housing stocks and home building stocks. To look at consumers spending, this is really looking at Bank of America credit card and debit card data. One of the things that we'll notice is that we've obviously had a very strong spike in terms of online spending due to the coronavirus, but that spend has slowly started to decline. And in that time, as it declined, brick and mortar spending has not picked up. So it's not like we've seen a decline in online spending that has been then offset by brick and mortar spending. So this is the slow grind lower that we're continuing to see on the consumer spending side, which will have an effect on consumer discretionary, consumer staples. These are some of the sectors that we're paying attention to, and we'll take a look at that in our sector review. On the unemployment side, so we've talked about employment numbers quite a bit over the past couple of weeks, but when we look at the unemployment, so right now we have 10 states that have finished paying the 6 weeks of the $300 a week in terms of fiscal stimulus. We still have 11 states that have not started that $300 a week, and we have 39 states that are currently in the process of paying that out. So this is a bit of more of a slower transition, but we do expect that there's going to be some coverage for a lot of states through the election or close to the end through the election, of which before that we don't expect that next fiscal stimulus bill to get passed. This is some of the angst I think investors have started to feel this week as it becomes more and more clear that we're unlikely going to pass a stimulus bill before the election. So this is driving some of that volatility here in this market. So let's take a look at the sectors themselves. We see quite a bit of movement here, especially with technology and discretionary that have been two of the strongest sectors starting to weaken. They're still leading, meaning they're still strong sectors, but they're starting to weaken. We're starting to see materials and industrials continuing to rotate into that leading category. Financials also probably a bit of a surprise for many investors that are in financials right now to see that it is strengthening and starting to get into that leading category. Energy still very weak. We're starting to see a bit of an uptick from utilities and real estate, but not really much movement. Staples is really the one that has moved over to the strengthening side. Healthcare remains still in the lagging space. Communications starting to lag a little bit behind, but still leading at the moment. So let's take a look at all of the sectors to give us a better sense. First, I want to take a look at materials, one of the sectors that have seen a substantial amount of strength here. Now, one of the things I want to point out is materials is sitting just at a major support level here around 62. 62, as you can see, has been a multi-year resistance level here, and now we're testing that as support. So the question is, materials being one of the leading sectors, meaning during the sell-off, materials did not sell off as much. Is this an opportunity to look for a bounce here on materials, or are we going to see a breakdown below? Because we have a lot of sectors that are here at this particular juncture where you are leading, but sitting near some major support levels. And this is a big test here for the markets, especially as we say markets are kind of hanging in by a thread. You know, are these sectors going to see some support and see some buying, or are we going to break down and markets are going to start moving here to the downside? We're seeing this across the board on some of the other sectors. Industrials, not as strong as materials, but also sitting near some major support levels here. I would argue that industrials is actually starting to see a little bit of a weakening here as it broke below some major support levels. It does have the 200-day moving average below here around $72 or so. But on the overall, if you look at industrials, it is still below a major resistance level. It tried to break out above that level last year before the coronavirus sell-off. After the rally, it could not manage to break back above it. It is now sitting back near towards the 20-week moving average or so. So I think there's a little bit more downside here to industrials, and look for that 200-day moving average to potentially hold here for industrials. If we look at XLC, same thing, communications trading just above that major resistance level that we have seen. So this is now providing a little bit of support. You do have a rising 200-day moving average. Money flow looking a little weak here on the daily chart. On the weekly chart, as you can see, it's just pulled back to that 20-week moving average. So there is some potential daily and weekly support here. But and communications from a fundamental perspective, especially if we think about the new number of rising cases, is still, you know, one of the sectors that has more of a lockdown support, if you will. So if cases start to rise, and especially as we enter more of a colder climate and people continue to work from home, this is one of the sectors that fundamentally should find a little bit more support here rather than see a significant break to the downside. So communications, weakening, but near a major support level like many of the other ones. If we look at real estate's one of the sectors that is really lagging behind and is near some support levels from the perspective of it's near the 200-week moving average. It is near this $34 support level here, but it is clearly one of the lagging sectors here. If we have a break below that, that's really where we can start to see movements down into that $30 level to the downside. So real estate not looking good. Fundamentally also not a particularly great picture for real estate. So this is one of the sectors that I would be watching for a potential breakdown here below that $34 level. When we look at XLF, you know, doesn't look like it's really strengthening, but it has provided quite a bit of protection here to the downside, meaning it has not declined as much as the S&P 500, hasn't declined as much as technology from that initial sell-off. So we are starting to see rotation into financials, despite the fact that the chart looks fairly weak. But we are, you know, near some major support or resistance levels here in this area as we start to test these levels here. it is fairly weak, and I know that this is not a particularly a sector that I think many investors are looking at. But this, I think, from a defensive perspective, as we look at how do we position ourselves if we do see some further weakness, financials is going to provide a lot more protection because it is trading at significantly lower valuations. They do have substantially better balance sheets than we had back in 2008 before the financial crisis. There are some legal and regulatory issues that are starting to come into light, especially the report earlier this week with the amount of money laundering that has been going through the financial system and some of the major banks that have been named as part of that. So there are some fundamental concerns here for XLF, but financials, as much as it may not seem, providing quite a bit of defense here in the current market sell-off. Consumer discretionary, this is one that is weakening, and we see quite a bit of potential downside to the next support level here. The next support levels here all the way down to about that 132 level. Even the 20-week moving average is still in the 136 level. So you have still a bit of downside before you can find some support here for XLY. So discretionary, especially when we look at some of the consumer spending data, and we're starting to see between the unemployment claims, or I'm sorry, the unemployment fiscal stimulus starting to run out for some of these states. We see the amount of retail online spend start to moderate, especially as brick and mortar spending is not making up for it. And you put all of those into context, I think this is where we could see a little bit more downside here for consumer discretionary. Especially when you look at names like Costco yesterday on earnings. I know Costco is in the staples space, but staples, I think Costco giving us a pretty good, I would say, sense for how consumers are spending money. And we've seen Costco numbers disappoint last night, which is why we've seen Costco decline about 3–4% after hours. This is, I think, in my opinion, a bit of a warning sign here to us for discretionary and potentially more downside here for consumer discretionary. With staples here, staples a little less downside, but still same thing, similar to consumer discretionary. You still have a bit more to the downside on the daily chart to that support level and the 200-day moving average. We are approaching the 20-week moving average, but usually we can see a little bit of an overshoot to the downside. So again, consumer discretionary looking, consumer staples strengthening, but it is approaching support, and there could be a little bit more downside here for staples. But staples providing a fair amount of defense here on the way down, not declining as far as the S&P or the NASDAQ. Lastly, XLU, utilities also lagging behind, and it is approaching some support levels here. You have some rising support here on the weekly chart. On the daily chart, as you can see, there's some rising support here. Not a whole lot of support, but that also means not a whole lot of downside here. So no matter how you draw your lines here, I think there's a small amount of downside here for XLU, but this is really one of the sectors that have significantly lagged behind the broader market. It's played a little bit of defense here on this recent sell-off, but long term, this is one of the sectors that has largely underperformed and will likely continue to underperform the broader markets. When we look at XLV, this is the healthcare. Healthcare has really started to deteriorate a little bit here over the past week. As it fell below that major 104 level, it has now approached the 200-day moving average. This is one that I think is worth keeping an eye out on. See if this breaks below that 200-day moving average or if it holds. It is trading now below the 20-week moving average, but as we have seen, once it breaks below that 200-week moving average, it has found some support. Perhaps it's able to find support at that 200-day moving average, but this is one that I'm going to be paying attention to because healthcare is starting to lag behind the broader markets. Technology is weakening, but it is holding in fairly well. But this is really where we see some potential downside here. You have this head and shoulders formation that has started to form here in technology. You see it in the same thing with the Qs. And if we break below those levels, this is really where we have a fair amount of downside here. XLK all the way down to the low 100s, high 90s before you find some real major support level. You have some minor support here at 104. So if you look at the NASDAQ 100 or the XLK, very similar chart. The only thing I will say here is XLK, as we continue to push new lows, momentum has not confirmed those new lows. This is potentially a bottoming process that is happening here in technology, because technology still remains one of the strongest sectors here out of all of the S&P 500 sectors. But it is, there are some concerns that we're seeing from this chart, and that does point to potentially more downside. XLE breaking down below that $34 level that we talked about a couple of weeks ago, got rejected at that level, still continue to decline. This is one of the sectors that I think will just continue to see further downside. I don't see a reversal here for energy. I don't see an uptick in terms of necessarily a lot of demand for oil, especially when you have news like California coming out, that type of news. I think that you're only going to have more and more countries and states potentially follow in those footsteps, and that's going to continue to put downside pressure in terms of demand for oil, and especially when we do not see airline or air traffic pick up yet. This is again further declines here for energy, in my opinion. A lot of investors have been asking us as to whether or not it makes sense to start looking for a bottoming process here for XLE, and I'm not saying that you're not approaching a bottom. You certainly, if you feel that XLE from an investment perspective is worth taking a look at, I think that buying perhaps the ETF itself is probably a better play than buying call options, because premium right now is extremely expensive. If you look at the VIX, you look at VXN, premium across the board is extremely expensive. This is now the time to be selling premium. If you're bearish on the market, sell call credit spreads. If you think that we found a bottom, sell put credit spreads. Use that premium now, because regardless of whether you're right or wrong, you can collect that premium so that if we do see markets start to break to the downside, you can use that premium to start buying puts. We've gotten a new elevation in volatility. A few weeks ago, things were a little lower on the downside. You weren't collecting as much premium. Now you're collecting a lot more premium. So whether you're selling cover calls, credit spreads, iron condors, you're generating a fair amount of premium. Now is the time to do it, especially when markets are still remaining fairly stable. On the ideas side, we have seen some pretty significant moves to the downside here for Boeing. Boeing crossed a pretty significant line in the sand here, which is a major support level around this 155 level, broken down below it. I think that there's a fair amount of downside here for Boeing down into the 130 area here. So Boeing breaking down below some major support levels. We've seen air traffic continuing to moderate, not picking up, especially if you look at airlines. They are losing more and more cash, and their outlooks are becoming increasingly dim. This is putting downside pressure here for Boeing. If you look on both the daily and weekly chart, this looks fairly weak here, and the weekly chart pointing us down to that 130 level or so here on Boeing. Both money flow on the daily and weekly chart extremely weak. On the flip side, looking for some bullish opportunities here, looking at Snapchat. Snapchat and Twitter remain extremely strong here. We've had a what looks like a nice little bottoming formation here, and looks like a potential breakout here. So what we have is a pullback here down to the 20-week moving average, and a potential breakout here to the upside as technology stocks like Twitter and Snapchat, is really how the new generation of millennials and the generation after them are ingesting our news, our content. This is really where we've seen a bit of rotation out of Facebook into some of these alternative platforms, and this is one of the opportunities that I still see within the technology space. So with that, we're just a few minutes from opening up here. Again, I want to thank everyone for your support and allowing us to continue doing this. We have a lot of things coming up here over the next couple of months with respect to new functions, new features to the platform. We're doing some things to improve the platform to allow you to quickly scan for credit spreads, giving you things like liquidity and IV rank within the platform. So we want to hear from you, and especially our members. We want you to know that we are willing to listen to your feedback and make sure that we incorporate that into what we build. And we've been doing these market outlook sessions for I would say about 6 months since the beginning of the coronavirus, and we want to continue to get your feedback as far as what you're getting out of this, what you would like to get out of this. So please send us an email at info@optionsplay.com, which I will send into the chat window. And please let us know if you have any thoughts as far as what we're doing every single week, what you like, what you don't like, new features that you want added to the platform. Please send us your feedback at info@optionsplay.com. And again, thank you so much for our members to support us and allowing us to continue to do this. Membership is just $75 a month or $500 a year. Please consider supporting us by clicking on the link on your screen. So with that, thank you so much. I hope that you guys have a great Friday. I hope that this was helpful in giving you a better understanding as to where we currently stand with the equity markets. We're about to open up flat on the day pretty much between the NASDAQ and the S&P 500. Pay attention to price action here today. If we get that acceleration to the downside, start testing that 260 level on the NASDAQ, start testing 323 to the downside on S&P, then we want to start potentially looking at some more bearish opportunities. Thank you so much and have a great trading day.